I'm going to be talking to you about the economics of social credit. But before I do that, I'll give you a bit of a background to the series of lectures that I'm going to be giving. One of the difficulties that many people face in trying to understand social credit is the fact that the theory behind it comprises so many different elements, and some of these aspects can be quite intricate, that it is very easy to get lost in the details. It is very easy to get to the point where you cannot see the wood from the trees. Now, the details, of course, are very important. They're extremely important, but there is also a time and a place for taking a step back or a few steps back and for attempting to grasp social credit as a complete whole. So what I'm going to try to do over the course of these 3 lectures this weekend is to outline for you the fundamental and most general characteristics of the social credit approach to questions of economics, politics, and philosophy. When it comes to social credit economics and to social credit political theory, perhaps the easiest way of understanding Douglas's ideas is through the use of an analogy. Just as computers rely on hardware and on software in order to function, in order to fulfill their specific tasks, economic and political associations also rely on a type of hardware and on a type of software in order to fulfill their tasks. In the case of economic and political associations, the raw material, we're talking about physical and human resources, so that would be the hardware, whereas the software would be the operating system, the economic and political system. If we look at the hardware, so to speak, of any Western country, and of many non-Western countries besides, it is evident that the raw potential of these countries to provide their citizens with a high level of security, with access to an abundance of high-quality goods and services, with increasing leisure, with economic and political independence, and with freedom, amongst other social goods, is not actualized to the extent that it could be or needs to be. Instead of providing citizens with highly satisfactory results, all of these countries fail to deliver the best possible outcomes. And further, they often deliver outcomes that are not desirable at all. Outcomes that are, in fact, the very opposite of what people seek from their economic and political associations. So how is this curious state of affairs to be explained? Douglas's central claim is that it's not so much society's hardware that is the problem as it is society's software. In other words, social credit maintains that the operational systems which govern economic and political association are faulty. They are not designed properly in view of the true purposes of economic and political activity. As far as the economic system is concerned, there is a key word for, if there is a key word, for understanding the economics of social credit, a word that goes right to the heart of the matter. I think that word would be balance. More specifically, I am thinking of the balance between consumer prices and consumer incomes. The problem with the existing financial system, in a nutshell, is that there is an inherent lack of balance between consumer prices and consumer incomes. In the process of production, costs and hence prices are always being built up at a faster rate than disposable incomes are simultaneously being liberated. So the basic idea is that if you were at any given moment to take a cross-section of the rate at which prices are being generated and the rate at which incomes are being distributed by the same productive process, it would look something like this. So we have a graph here of a mythical company, and you'll see that the rate at which prices are being built up exceeds the rate at which consumer incomes are simultaneously being distributed. Another way of depicting the same state of affairs is this cartoon, which was produced some time ago by one of the pilgrims of St. Michael. It's called Le Chariot Boiteux, or the wobbly chariot, the wobbly wagon. And you'll notice that one of the wheels, the one representing prices on the left there, is much larger than the corresponding wheel representing purchasing power on the right. So there's a lack of proportion between the two wheels, and of course this must result in a very uncomfortable trip, or in a trip that goes nowhere except maybe in circles. Right? So the idea is that our economy is basically like this. C.H. Douglas cited 5 main causes for this deficiency of consumer purchasing power in his booklet, The New and the Old Economics. Let me find it here. Here they are. So he listed profits, savings, the reinvestment of savings, deflationary financial policies on the part of the banks, and lastly, the difference in circuit velocity between cost creation and price liquidation. This last cause, which is the main cause, is also known as the A plus B theorem. And I won't torment you with lengthy explanations, but the basic idea is that in the case of modern industrial production, we have overhead costs. And these overhead costs, because of the way in which real capital, machines and equipment is financed, and the way in which its costs are accounted for, costs and hence prices are built up without distributing a sufficient volume of consumer income in the form of salaries, wages, and dividends. Apart from any question of theory, the claim that there is a gap, a significant gap, between consumer prices and consumer incomes is one that can be easily verified by consulting the economic statistics of any developed country. Take a look, for example, at these statistics from the Canadian and American economies in 2008. In 2008, the GDP in the United States was a little over 14 trillion, while total incomes that were earned in the form of wages, dividends, and salaries were a little over 8 trillion. So that meant that there was a gap of 5.9 trillion. In Canada, in 2008, the GDP was 1.2 trillion, while the total incomes were 770 billion. Thus, there was a gap of 436 billion. So we see that in these two countries there was a disparity between consumer prices and consumer incomes, and it was significant, it was not small. But just a word of caution, I don't believe that these statistics tell the whole story. I think the situation is more complex. So I wouldn't assume that these statistics reveal the exact nature and extent of the gap. To make that assumption would be probably somewhat misleading. But the important thing to recognize is that regardless of the various causes, there is a gap and it is significant. So there is an imbalance at the root of the modern economy, and this imbalance must be consistently overcome or compensated for to some substantial degree. Because if it isn't, the economy would enter into a downward recessionary spiral and would eventually collapse. If additional purchasing power is not drawn on from some other source to equate the prices of existing consumer goods with available incomes, businesses will scale down production, more people will be unemployed, and this will decrease available incomes even further, thus intensifying the original problem. Additional effective purchasing power that is not derived from existing production has to come, obviously, from some other source. There are essentially two ways of providing this additional purchasing power. There are the conventional methods, the palliative measures that are actually employed in economies the world over, and then there are the social credit methods, the alternative. Now, the conventional methods rely mostly on the creation of new money in the form of debt to fill the gap. Incomes derived from new production, especially capital production and production for export, and incomes or purchasing power derived from additional government expenditure, as well as purchasing power derived from consumer loans, that's to say credit cards, lines of credit, car loans, and mortgages, help to offset the consumer prices that are currently on the market, but only at the cost of increasing public, corporate, and consumer debt. The problem with relying on debt money to fill the gap, as we currently do, is that it does not liquidate the outstanding consumer costs. It merely transfers the obligation to pay them to a future point in time. But that future point in time will also have its own gap costs to meet. Since consumer incomes in the future will be eroded by the additional debt servicing charges, they will be even less adequate to meet the recurring gap. The increased lack of liquidity translates into an even greater need to borrow in order to meet the needs of the moment. So what ends up happening is this. Debts are paid off at a slower rate than new debts are contracted, and this leads to an ever-increasing mountain of debt, which in the aggregate is unpayable. Under the current system, the richer a country becomes, the more indebted it must be. It is penalized for making use of its real credit with a millstone of debt. The United States, constituting, as it does, the richest country in the world in physical terms, is also the most indebted. Total debt outstanding in the United States, public, corporate, and personal, is somewhere in the neighborhood of $61.6 trillion, or roughly $193,000 per citizen, and is steadily increasing. The U.S. national debt alone is around $17.7 trillion, or $55,000 per citizen, and is likewise increasing. That figure represents a federal debt to GDP ratio of 105%. The money supply, on the other hand, is only about $11.4 trillion. Indeed, if all of the money in circulation were used to pay off as many of these debts as possible at any given point in time, the U.S. would have no money supply whatsoever, and yet massive quantities of debt would still remain. A good source for these kinds of statistics is the website, the usdebtclock.org. Let's see if I can, here it is. And I think that if you take the time and check this out, you'll see that the information which is provided is sufficient to boggle the mind. The financial system in the United States is not different in kind from that of any other country. Furthermore, the pressure of debt repayments, because it erodes consumer incomes, leads to demands for wages and salary hikes in order to keep up with the cost of living. This helps to decrease the size of any outstanding debt relative to income, but it also leads to continual inflation. Right? Wage and salary increases, unless they come out of profits, will register as increased costs that businesses must eventually recover in prices. This helps to explain why, in the last 100 years or so, the American dollar, for example, has lost about 95% of its value. All of these things, continual inflation, expanding debt, economic instability in the form of the business cycle, are symptoms of the underlying imbalance. To that list, we can add taxation. According to the Canadian Fraser Institute, the average Canadian family in 2014, this year, earned enough money to pay all of the various taxes imposed by all the different levels of government by June 9th of this year. So that meant that almost half of the family's yearly salaries were going to pay taxes, almost half of the year working for the government. Other symptoms of economic failure that stem from the gap, or the way in which it is conventionally filled, include poverty and servility. If every modern industrialized nation can easily produce in brute physical terms everything that is needed to feed, clothe, house, educate, and look after people's health and well-being, how is it that in every industrialized country there are still people in 2014 who do not have easy access to all of the goods and services that they need to survive and flourish? In 2012, for example, 15% of the American population, or 46.5 million people, which is larger than the population of either Canada or Australia, were living in poverty, as were 21.8% of all children under the age of 18. The explanation has to do not with a lack of goods and services, but with a lack of purchasing power. Similarly, as technology progresses, as it advances, and we are able to produce more and or better goods and services with less and less human labor, there should be a decrease, a reduction in the need to work. In other words, we should be enjoying more leisure time alongside the progress of the industrial arts. Yet it seems that many people are having to work longer and longer hours in order to make ends meet. By way of contrast, it is reported by reputable historians that in Merry England in 1493, for example, the average peasant only had to work 15 weeks of the year in order to provide for his family, and he also enjoyed 150 official holidays each and every year. Again, according to social credit, all of these economic problems have nothing to do with physical scarcity or with technical problems with production or with free enterprise, with private property, the profit motive, individual initiative, or free markets. They also don't have anything to do with alleged defects in human nature as such, or with inexorable economic laws. Rather, they have to do with this gap between consumer prices and consumer incomes. I won't be able to go into it in any great detail, but I should also point out that this imbalance between consumer prices and consumer incomes, this imbalance in the financial system, which then yields so much dysfunction in the economic order, also induces imbalance and dysfunction in other spheres, in social spheres, cultural spheres, and environmental spheres. At this point, one may ask, if the conventional methods of bridging the gap lead to so much economic dysfunction, so many economic troubles, why are they persisted with? Well, the simplest answer, I think, to that question is that the existing banking system holds a monopoly over the money supply. Most of the money in any modern country exists in the form of bank credit, not in the form of bills and coins, and most of that is created as the counter to a loan or a loan equivalent. In other words, most of the money is created by the banks in the form of debt money. So we fill the gap with debt money because we have no other choice under existing conventions. But there's no reason why these conventions could not be suitably altered or changed. There is an alternative. If we want to make the additional purchasing power that is needed to bridge the gap fully effective, it is clear that this money should be created without debt and freely distributed to the consuming public as an increased income and in the form of lowered prices. Of course, any such adjustment implies that the monopoly of the banks can and will be broken. The power of credit, while managed by private banks, would have to be treated as a public utility and made responsible to the public interest. Only then could additional credit be created without creating new costs and then be used to make up for the deficiency. So this, in fact, is, in a nutshell, the social credit solution. Instead of filling the gap, as the present system does with debt money, social credit proposes to fill it with debt-free money, automatically balancing the flow of consumer prices with the flow of consumer incomes by simply creating debt-free. Sufficient money to achieve this equation would allow for the distribution of all of the surplus goods without creating an unrepayable mountain of public, corporate, and personal debts. Social credit also promises to eliminate, by getting to the root of the problem, all of the other symptoms of economic dysfunction that I had previously mentioned. So we can reasonably expect poverty, servility, the ups and downs of the business cycle, inflation, and heavy taxation to go by the wayside. The flow of compensatory debt-free money would be used to increase the flow of consumer incomes on the one hand, and to simultaneously decrease the flow of consumer prices on the other in order to equate incomes and prices. So we have a little schematic of how a social credit financial system would work here. The first method of increasing consumer incomes, which Douglas envisaged, is of course the national dividend. And this would be a sum of money given to each individual citizen on a regular basis, whether he be employed or not. It is ethically justified or justifiable by the fact that the primary factor in modern production is what Douglas referred to as the cultural heritage. All of those inventions, discoveries, patterns of organization, etc., which were developed by past scientists, engineers, and organizers, and are primarily responsible for the enormous productivity of the industrial economy. So this belongs as a legacy to each member of society, and it's entirely appropriate for each member to benefit from the employment of this cultural heritage in the process of production. From a more pragmatic point of view, with the increasing tendency of technology to replace human labor in the productive process, it is simply not possible for everybody to be employed. A policy of full employment makes absolutely no sense when machines are doing more and more of the work. In the limits, in 200, 300, 400 years perhaps, We can conceive of a society where all production is carried out by computers, robots, androids, etc. And at that stage, it would be sheer lunacy to insist that every human being must work if he is to have access to goods and services, because at that point there would simply be no meaningful work for people to do. A recent article that was put out in the American mainstream press indicated that within 20 years, 50% of the jobs in the United States could be automated on account of developments in artificial intelligence. So there must be some way of providing for those people whose labor is no longer needed by the formal economy. They must be able to have some kind of access to goods and services so that they can survive and flourish. The alternative would be to tell them to dig holes and fill them up again in order for them to get their meal tickets. And that, I don't think, is a very satisfactory or sensible option. In fact, as machines continue to replace labor, we would expect salaries and wages to become less and less important, and for the national dividend to cover more and more of the monetary costs of living in a social credit society. The second method of decreasing consumer prices, or the national discount compensated price, has to do with what Douglas referred to as the just price. This would involve reducing prices in keeping with the consumption-production ratio. Because of the way in which real capital is financed, the financial prices associated with production exceed the prices of all of the raw materials that are consumed in the process of production. One of the key social credit axioms is that the true cost of production is consumption. So if that's the case, we should not charge the public more than what was actually consumed in the process of production. Compensated price would therefore reduce retail prices, those prices that would be charged to the consumer, while simultaneously providing sufficient debt-free money so that producers are able to cover the rest of their costs. The idea is that retail prices would be discounted by a certain percentage, and the difference would be made up to the retailer, to the seller. So if the average consumption-production ratio in a given period of time were of the order of, let's say, 70%, then there would be a 30% discount on all consumer items. A car priced at $10,000, for example, would sell for $7,000, and $3,000 would be granted to the seller so that he could cover the remainder of his costs. The dividend and the compensated price would require the establishment of a national credit office. That would be an independent entity, an organ of the state that is free of all and any political interference. And the chief task of the National Credit Office would be to simply create and issue sufficient debt-free money in accordance with the relevant economic statistics. So you have the National Credit Office there in the middle, kind of coordinating the whole system. So that's social credit economics in a nutshell. There are two misconceptions that are quite common and which need to be avoided. The first, and I'm sure most of you are keenly aware of these, but in case you're not, the first misconception, of course, is that social credit is some form of socialism. The fact that the word social appears in social credit does not help our case much on that score. But I think that if you analyze it closely, there's really no basis for claiming that social credit is a form of socialism in any conventional sense. The dividend, for example, is not financed by redistributive taxation. It's new money, debt-free money that is created for that particular purpose. There is also no question in a social credit economy of nationalizing the means of production. or of a centrally planned economy. And I think that economic regulations would be a lot more sensible and a lot fewer in number than they are at present. The difference, one difference anyway, between capitalism and social credit is that under social credit, each and every individual would be regarded as an owner in the productive capital and would receive a dividend on the basis of the operation of that capital. So under social credit, we would all be capitalists, at least to a minimum extent. The other misconception, is the claim that social credit is utopian, that it's pie in the sky. And I think it's important to underscore that social credit does not aim at a mathematically perfect society, but rather at a healthy society. A healthy society requires a healthy financial system, one that is balanced rather than unbalanced. And why should health or well-being be objectionable? Another key social credit axiom is that whatever is physically possible should be financially possible. If we can live much better in a more satisfactory way under a financial system, a reformed financial system that accurately reflects what's going on in the physical economy, why should we not introduce such a system? What good reason could anyone possibly give for objecting to improving our common lot? So that was the wholeness of social credit economics in a nutshell. And I don't know if there are any questions. We'll have time for questions, I suppose. But if there are, I will do my best to answer them.
Okay, yeah. With the National Credit Office, what would stop that from becoming corrupted? Like, couldn't greedy individuals go in and manipulate that in a way that would benefit them more than others?
Corruption is always a possibility. The idea is that the National Credit Office would function on the basis of statistics that would be regularly published and checked.
Okay.
So the idea is if you have open statistics and anyone can analyze them and question them, then you can keep the accountants honest. It would all be published. Perhaps some other mechanism might be necessary in order to watch the watchers, but we'd have to see in practice how that would play out.
Basically, wouldn't that just, like, if you're investing more money, or the national credit is invested more into industry than to people, and again, wouldn't that cause a spiral again with prices? Prices would continue to go up, thus forcing the government to create more, or the office to create more wealth, which would then increase the prices and just spiral up?
The compensated price is designed specifically to handle that. So the idea is if you can lower prices as a condition of selling them, then it becomes a lot more difficult for people to take advantage. Now, Douglas also postulated or entertained the possibility that you may have to get people to agree to a certain rate of profit on turnover, so that all businesses would say, well, in this particular field, we'll take 10% more, but no more on turnover. And then you would be able to keep prices and incomes in equilibrium. So definitely that's a potential danger, but you'd have to have some way of ensuring that it's not being taken advantage of.
I just want to tease that point out about, I guess, dividends distributed by the National Credit Office inflating prices. Certainly for goods that are going to be consumed, you can understand that concept. You need prices to be deflated so they can match incomes and purchasing power. But for fixed assets, say like factories, houses, whatever else, what would stop there being a sort of permanent spiral in those fixed asset prices over time just going up? You're talking about, say, regulating the rate of profit on each type of industry, which obviously would then presumably fix asset prices over time, or to tie it to a certain proportion of that rate of profit over time. But wouldn't there be some danger of, I guess, fixed assets? We're talking about the big purchases people make in their lives, or the big investments that companies may make, that over time, I mean, obviously that's happening now. Those prices have been inflated by debt at the moment. But what would stop a similar situation occurring in terms of just asset price inflation in large fixed assets in the economy?
part of the solution, I think, would be that the interest that people would have in making a quick buck in a social credit economy, I think, would tend to disappear. Because with economic security provided by the dividend and the compensated price, presumably there would be less of a tendency on the part of people to want to speculate in various ways. The other thing is that, and there are different views on this, but you could also regulate the flow of producer credit. And that also might be helpful if you would say that, if the National Credit Office was tasked with creating producer credit and make sure that it's only being used for certain legitimate purposes, that also might be of some assistance.
Well, look, I guess under the current system, that's happening anyway. And at some point, the bubbles will burst around the Western world as the quantitative easing, the interest rates start to ratchet up, and then prices will start to deflate. And there'll be a large debt overhang as people go into liquidation. And it'll be like a Japanese situation and for the Western world. And people might be aware in Japan, asset prices have been flat for 2 decades or more. They had their bubble and they're still living with it. That's why they've got century mortgages. And trying the impossible task of paying it off. Look, just on another aspect, in terms of funding the necessary services that government would then undertake, how would the National Credit Office, I guess in the sense it'd be a power over government dictating to government, okay, this is what you would receive as your share of the dividend for funding the essential services for the country?
Well, you could do it that way. There are different ideas on this. You could use part of the compensatory money to fund government programs and government production, government services, or you could get the government to borrow the money from the National Credit Office, as if it were like a private company, and then recapture whatever costs through, let's say, a simple sales tax. I think I prefer the second method, but in any case, you'd also have to introduce political changes to ensure that whatever the government's doing, it's really backed by the support of the people, and they're not taking advantage of their position to spend money, spending really, the real credit on things that people don't approve of.
The free enterprise system would still operate. So to regulate profits, there would be still that element of business competing against business. That'd be right?
As far as the profit regulation mechanism is concerned, of course, we would only need that if inflation is going to be a problem. There's no question of putting limits on aggregate profits, so it's just on the rate per unit, let's say, or on turnover. Businesses that are more efficient would be better positioned to make larger profits, and so the incentive would still remain. There's no question of interfering with private property or free enterprise or personal initiative or the profit motive, for that matter.
A couple of questions, Oliver. The first was in regard to industry, new industry, if you like. The difference between, say, speculative and the actual cost of production of establishing a new industry. I just wonder if you'd explore that.
If you have a system where producer credit is controlled by private banks, but ultimately by a National Credit Office that would, gives some kind of oversight, then you'd be in a position where you could put some pressure, levy some pressure, and ensure that businesses that are borrowing this money are doing it for the sake of real production, real goods and services, and not merely for speculative gain. As I said before, I think in a social credit economy, these sorts of activities would tend to be not as attractive as they are at present. People are forced by economic security to treat the economy, if they can, as a kind of casino. And if the economy goes back to doing what it's supposed to be doing, effectively, efficiently, then, if you want to gamble, you would go to the actual casino rather than playing with the economy.
Yeah, I have a problem. People say they make goods or services to make money, but in actual fact they don't make money, they earn money by providing it. Is it a psychological problem that's got to be overcome? I mean...
Well, I suppose one of the major problems is that many people, I suppose most people, do not understand where money comes from, don't understand who creates it and under what conditions, under which terms. And so we certainly have a number of sayings or idioms in our language which can be quite misleading. So when someone says that they make money, of course, they're merely getting money from somebody else, and that money, the bulk of it anyway, was brought into existence by the operation of private banks. Yeah.
I suppose it's like the word cool being used now. It's not anything to do with temperature. It could be to defining something that's unusual or fascinating or whatever. So when the last time I had a haircut, I asked the barber if he cuts hair to make money. And I asked him, well, why does he expect me to pay for the haircut if he's making money?
Oliver, can you flip back there to causes of the gap, please? Yes. I have a question on 2 and 3, savings and reinvestment. I don't know about reinvestment and savings. I can't see savings being a cause of the gap. To me, savings is deferred spending. Can you...
Well, savings are a potential cause of the gap insofar as something is produced, income is distributed in the course of its production. If any of that income is not then used to purchase the production, if it's saved, then of course you're going to have less purchasing power to offset prices. Now, when it comes to macro flows, it's possible at a particular given point in time that past savings that are now re-entering the market may be re-entering at a greater rate of flow than present savings are being made, in which case, at a macro level, savings would not be contributing to a gap. But I think the general tendency is that the net rate of savings can be represented as a positive value. And so there is always money that is supposed to go to the purchase of consumer goods and services that is being sequestered. And but we need that money to fulfill to take goods and services out of the producing system and into the consuming system. So as long as, or to the extent that there's a reservoir of money that is being extracted and held apart, we're going to have a problem. But I'm sure we will discuss this further.